Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. It was another good week for the equity markets this week, with the European stock markets doing particularly well, up more than 3% in several cases. The FTSE was up 2.6%. How strange to see a number 8 in front of that particular index. And the S&P and Nasdaq were up a little short of 2% after a sell-off on Friday, being strong before that. The Japanese market was the worst performer amongst the leading markets, and the yen remains astonishingly weak. China also did well, up more than 4%. That has been making a strong recovery this year. Meanwhile, in the bond market, in the US, Treasuries finished the week roughly where they started in terms of yield. No particular news there, while in the UK, we saw gilts nicely up over the whole curve over the course of the week. This may have been influenced by the news that the UK has formally come out of recession in the first quarter. GDP was up around 0.6%, though unfortunately if you take a slightly longer perspective, look back to just before the pandemic, we find that the UK economy is only grown by around 1.7%, which is a long way behind both the US, up 8.7% over the same period, and in Europe, where the average gain in GDP has been around 3.8%. So the UK economy is still very much in the doldrums, although the Governor of the Bank of England was in slightly more positive mood this week, following the Monetary Policy Committee holding interest rates again this month, but hopes rising of an interest rate cut next month. Whereas in the US, the first quarter earnings season has produced some positive above expectations results. Turning to the investment trust universe, the investment trust index was up 3% this week, one of its best weeks, I think, for a long time. And the average discount has finally started to move in, down to around 13.4% as of yesterday morning. That's down from a peak of 18% last year, and more recently settling around 16%. So definitely signs of improvement there. And that was reflected in the individual performance of investment trusts, with gainers this week outnumbering losers by more than 4-1. Best performer of the week, by chance, happens to be HydrogenOne, the specialist hydrogen early-stage venture capital fund, whose manager, Richard Hulf, is on the podcast this week. I shall be talking to him shortly about where his trust is going now and what are the prospects for his specialist investment area. Also on the podcast, I'll be talking to Joseph Rowland, who's a senior fund analyst at Investec, to try and get an idea of how the world of investment trust seems to one of the larger wealth management firms. Investec recently combined with Rathbones as part of this wider consolidation of the wealth management industry. So there's some interesting insights there about how wealth managers are treating investment trusts. Obviously, been a lot of concern about cost disclosure and regulatory pressures driving up the threshold in terms of market capitalization at which wealth managers are willing or able to buy investment trusts. More on that then we'll be discussing shortly. Turning to the news, first of all, we had only a handful of results this week. 5 trusts reporting annual results for 2023, and they included 3i Infrastructure, which turned in another excellent return, NAV total return up 11.4%. ICG Enterprise, ticker ICGT, the private equity trust, up 2.1%. 3i Group, up another 23% NAV total return, I should say, in 2023. Extraordinary gains from 3i over the last few years. And also we saw some results from North Atlantic Smaller Companies, ticker NAS, whose NAV total return was pretty flat. And finally, a debt fund, ICG Longbow Senior Secured UK Property Debt, ticker LBOW, whose NAV total return last year was down 33%. That one is not one for the ages. Plenty of news is all summarized in our weekly email, open to subscribers to the Moneymakers Circle, where this week our profile is of Henderson High Income. which sits in its own specialist sector, but we ask the question, is it really that different from a more conventional UK equity income trust? You'll find that profile on the website as well. And then in other news, the most surprising news perhaps of the week was the announcement that Ashoka White Oak Emerging Markets, ticker AWEM, which only listed on the market a year ago and has a very tiny market capitalization, just 35 million, has made an audacious proposal to take over HGEN, ticker DGN, which recently merged with its Aberdeen stablemate, Aberdeen New Dawn, and has more than 800 million in assets. So this is a David and Goliath story, but the interesting point about it is that this initiative was apparently driven by the shareholders of HGEN, not by Ashoka itself. And those shareholders have come up with the idea of effectively reversing HGEN into Ashoka White Oak Emerging Markets, with a cash exit for up to 50% of HGEN shareholders at a 1% discount. The board of HGEN, who no doubt have been a little discombobulated by this approach, have not yet formally responded, but have told shareholders to do nothing until they make an announcement shortly. Elsewhere on the corporate side, the battle for Hypnosis Songs, ticker song, is finally over after Concord, which was one of the two bidders for the assets of this Music Royalties Trust, effectively withdrew its bid, and so Song will in due course be taken over by Blackstone, the US private equity fund, which already has a joint venture with the current managers of Hypnosis. So that's an end to the saga at a price of $1.30 per share. Elsewhere on the corporate front, we also heard from Aquila European Renewables, ticker AERI, that it's no longer looking for a merger partner, and that follows the news that the shareholders owning more than 25% of its share capital said they would not be in favour of such a combination, as a result of which all three indicative offers that the board of Aquila European Renewables has received, the only one of which has been named being Octopus Renewables Infrastructure, will not now proceed. The board will now broaden its strategic review, it says, and consider other options, including a wind-down sale of assets or a continuation of its current strategy. There'll be another continuation vote for this one in September this year. Also some news on the management front. We learnt that North American Income, ticker NAIT, is moving its investment management arrangements from Aberdeen to Janus Henderson, and the lead manager, Fran Redano, will be moving firms as part of that process, with the fee also being cut. And at Rights and Issues Trust, an interesting small specialist UK equity trust managed for many years by Simon Knott until about 2 years ago, when the arrangement moved to Jupiter. But the main manager on the trust, Dan Nichols, is going to be retiring at the end of June, so he will be replaced by another Jupiter fund manager, Matt Cable. We also heard that Triple Point Social Housing, ticker SOHO, S-O-H-O, is conducting an independent review of its management arrangements, which is expected to take around 3 months, when we'll learn what plans the board has there. And finally, we learnt that Scottish Mortgage, the largest investment trust of all, ticker SMT, has bought back 35 million shares at a price of 894p in just 1 day last week, spending a total of more than £300 million, which is believed to be the largest single share buyback ever recorded. And there's speculation that this may be a transaction involving Elliott Management, which recently disclosed a 5% stake in the trust. If so, that will reduce its holding from 5% to around 2.5%. Very profitable intervention by this well-known US activist fund, taking advantage of the widespread discounts which we've observed last year. Nice work if you can get it. So my first protocol this week for the Investment Trust podcast was to talk to Richard Hulf, who is the co-founder and managing partner of HydrogenOne Capital, which launched an investment trust of HydrogenOne back in July 2021, one of the most recent new companies to get through the IPO window before we had the great shutdown after the interest rate and inflation shocks. So, Richard, I'd like to start, if I may, by talking to you about your trust. It obviously invests in hydrogen and hydrogen-related businesses. I'm going to tell you what I know about it. I don't know a lot about it. It's not a trust that I've owned or indeed looked at in great detail. But basically, I'll tell you what I see, and then you can tell me if what I see is correct, if you allow me to do that. So what I see is a interesting specialist vehicle that came to the market 3 years ago, traded at a premium for a short while before this seismic change in the way that investment trusts have been rated over the last couple of years. So now you trade at quite a significant discount. You have net assets around 130 million, so it's still quite small. And you are an early stage growth style investor, if I can put it that way, as I understand it, in companies that are trying to make money out of exploiting hydrogen. So it's a very interesting niche area, but unfortunately it's got all those characteristics which are currently out of favor with investors, shall we say. So I guess I have to start by saying that has been a bit of a challenge for you and probably a big disappointment as well so far.
Yeah, hi, Jonathan. Very nice to be here. That is a pretty decent first pass summary of where we are, but we need to qualify that and understand a lot more about what's going on in the hydrogen sector. So yes, we were very grateful to be able to come to market 2021, raised 130 million and invested that very quickly, sort of at the advice of some of the market commentators at the time that, listen, guys, you've got to demonstrate that this is an investable sector and you've got to move fast and make some of the best investments. So we did that on the basis that the market would carry on growing. We'd be able to, as investment trust, come back and raise more capital. And by now we would have been a £500 million investment trust and everything would have been rosy. And it's interesting that you make that observation about the share price going up and coming down. We were going up for quite a while when a lot of other shares were coming down. And we just thought people just haven't noticed that we've been going up. And it's going to get to the point where people are going to start trawling along the bottom, looking for those things that haven't sort of followed the trend, which, as you rightly pointed out, was sort of exacerbated by risk-off trading and interest rates. But really, we're an investment trust uncommon in the space in that we're about growth. This is about capturing a once-in-a-decade trend of the energy sector starting to move away from fossil fuels and greening up and using hydrogen in part of that journey. So it's about growth. So this is about investing €1 or $1 into a hydrogen company, a company that's making fuel cells or electrolyzers or pipes or transmission, or indeed it could be a company that's making hydrogen itself. It's buying green electricity, buying electrolyzers, establishing an offtake and selling hydrogen onto other parties. So it's all about growth in that sector, but it's about industrial growth in that space. So a lot of retail investors that came into the story originally are starting to think about, well, when am I going to see my hydrogen car? When am I going to better refuel with hydrogen on the forecourt? And you're just not seeing that. And you won't see that well into 2030, because at the moment, the entire thesis is about replacement of grey hydrogen made through heating up steam and methane to a very high temperature, used for making fertilizer, used as a reducing agent in making steel and cement, used as backup power. So this is all about investing into the industrial space, which is on the move now. And a lot of retail investors that came into the story have not seen visibly the industrial growth, which is still as strong as ever and getting stronger. So we've had the triple whammy effect of being an investment trust, a UK company, a growth investment with not a lot of visibility amongst the arriving shareholders that owned it. Now, if we go back over to the institutional class of investors, which is most of the shareholdings in the fund, and we talk to our investors regularly, they're not happy. No, obviously, nobody's happy with the share price, but they're totally happy with the sector, about the performance of the industry reflected in our NAV, which is like a bottom-up industrial calculation of the valuation in the fund. And we are trying to do everything we can to explain to investors in the market that since they've invested and we've invested into the sector, things have just got better and better. They have taken a step back in the UK, but this is a global fund. So we're talking about investments in mainland Europe mostly. We're now eyeing up investments into Canada and North America. If we can raise more capital, it's a global growth phenomenon that is just not stopping. And that's what investors are getting exposure to. And we're having to work hard because we're in a tricky space, but we are confident about the asset value of what we've invested into. We've got plenty of cash to be a going concern, to carry on maintaining our position in the space and just planning for the worst and hoping for the best.
Right. So you've described that very clearly and very carefully. So there seems to be two questions there. One is, why should I ever want to invest in hydrogen? It's not exactly new. I think that hydrogen could be part of the future of energy supplies and energy security and green transition and all the rest of it. I was at MIT for a year about 30 years ago, and they were talking about hydrogen and fuel cells and things like that way back then. And it always seems to be one of those things that's just around the corner but hasn't yet quite arrived. But you're telling me that isn't the case. So first of all, why should I be interested in investing in hydrogen per se? And secondly, the question is, why should I be looking to invest it in a listed vehicle like yours, which invests in what are currently unlisted companies? So what's the answer to the first question? Why should I want to invest? It's a growth business. You've made that clear. But of course, growth itself or even new technology doesn't guarantee profitability. So how would you answer that question? Why hydrogen?
So you're absolutely right. People have seen hydrogen before, and people were talking about hydrogen cars back in the 1950s and the 1960s. This time round, it's not so much about mobility. It totally makes sense for small vehicles to be electric powered through batteries. But there are certain parts of our economy which are very, very hard to decarbonize. Industrial hydrogen, transportation and mobility, where you've got very high loads over long distances, HGV trucking, and where you've got industrial processes that have to have hydrogen being used in steel and cement and so forth. So the reason that you need to invest into this now is that it's happening now. There is large-scale capital investment into hydrogen industrial projects. Green hydrogen projects are going ahead. We're taking final investment decision on 2 of our green hydrogen projects, one in Norway, one in Germany this year. The offtake agreements have been signed. It's going ahead. The reason you need to invest now is that it's happening. Don't look to your local forecourt as a retail investor to see that hydrogen is happening. You have to look at the information that we put out that describes how hydrogen is moving in the industrial complexes. So it's happening now. Now, why should you invest into the fund now? Because we've been carefully selecting the companies and projects that we've invested into over the last 2 years. And we said to investors that we will first of all demonstrate the sector is real by seeing revenue and ultimately earnings growth amongst these companies. These are all businesses with 2 or 3 factories, 2 to 500 employees, measurable market share of the electrolyzer market. It's demonstrable that these companies are real and they're happening. The way this fund is going to generate a return on investor is not just by steadily increasing revenues. That is like a health measure. The real value gets created when we say that we invested £1 into Sunfire and it's just had an IPO in Germany, and the equivalent uplift, the multiple on invested capital, the MOIC, is 3 times what we invested. Or we could say the HydrogenOne, the fuel cell maker, Hyundai were an early stage investor. Baker Hughes have just invested as well. Who knows? We're not saying that this is what's happening, but one of those 2 companies will say, right, we're just going to buy HydrogenOne now because we need this technology. We need the IP. We're using it in our ships. It's proven it's happening. And we're entering into the window now of the portfolio of 8 or 9 companies where at any moment, and I can tell you 2 of the companies already in the portfolio have appointed investment banking advisors. Obviously, we can't say which. Why have they done that? Because they're entertaining the prospect of a sale or of an exit through an IPO. So it's mostly trade sale because the big industrial players around the world that haven't been investing into hydrogen are having to catch up quickly. So the reason to do it now is that it will suddenly happen and you'll miss it when we announce that company X has just been bought by company Y. And that's why people need to look at this now.
From your presentation, I see that these companies are growing their revenues, most of them anyway, but are any of them actually making any money at the moment?
Well, that's the argument we need to get into. Does acquirer A of company B that is just produced that they can sell electrolyzers at an industrial scale, does it need to see the revenues? It doesn't really need to see. It's not buying the revenues of that business. It's buying the early factories that it will use as the starting point to build its own bigger factories, to build more of those units at scale. It's like any new sector. It's the intellectual property. It's the R&D that's been funded by somebody else for the last 10 years, which has now become commercial. There's clearly an order book. They want to see the order book. They want to see a tried and tested product. Whether there's revenues at scale, it's because it's not an established sector. These people that are the incumbents, the people that are buying into the sector, are the ones that generate the super scale revenues going forward. And that's what we try to capture into our valuations of these businesses. So it's not based on revenue multiples now. It's based on the discounted cash flow of all those future revenues that will come as these businesses scale up. So that's where we are. And this is where you get phenomenal growth potential, which is valued rather than existing revenues and growth, which is the way to measure established sectors. But we're in a new sector here.
So before we go on with that, you said earlier you had enough resources to go on funding these companies, because presumably a lot of them do require capital of some form or another, and you will then have to decide whether to invest again or not to invest again. Do you have enough cash to do that? In other words, because you've obviously invested a lot of money since the launch, you haven't been able to raise money through equity issuance, which is a disappointment, and I don't think you have any gearing at the moment either. So what's the outlook as far as that? Can you keep this business going while you're funding these fast-growing companies?
Yes, it's an excellent question. And let's be completely straight here. We have enough cash to carry on with maintenance capital of some of these businesses going forward. And some businesses have been doing further fundraising over the last year. And in those situations where we couldn't stand our full corner, we had dilution protection. And we still have that on some of these other companies. So we've got that card to play within the portfolio, but we can only play it once. The next time they raise capital after that, you need to follow on. Now, the way that works is that when you sign the sales and purchase agreement to invest into the business, anti-dilution says that if new shares are issued, you will get issued with shares for free to keep your equity position in the business. So we have that first card that we can play. We will have to pick between some of the different companies in the portfolio. We probably will have to sell some of our shares in the existing businesses at current net asset value to sacrifice to put that capital into some of the other businesses in the portfolio. But even that in itself will demonstrate to the market, who clearly don't currently have confidence that the value of these businesses is at net asset value, because the shares are trading at about half of that. But even just demonstrating that we've sold some shares at NAV from this business to redeploy into this other business, because it's so much, the upside is much sooner and it's so much more material. So there'll be a bit of that goes on as well. And in the third situation, yes, we may have to be diluted and not follow on our position into these businesses. But what we've also done is protected our board positions, because in pretty much every company in the portfolio, we sit on the boards of those businesses, and we've got protections there in return, in reward for being an early stage investor. Even if our equity position went below a certain threshold, we've still managed to preserve our board positions in there. There would be dilution in some of those businesses in the worst case scenario, but compared to maintaining that company and looking at a multiple of invested capital on exit, it's a relatively small price to pay. But yes, we would like to be able to raise more capital, and we had expected to do that by now. But we've got to look at the worst case scenario, and that is that we can carry on the fund until things improve.
Okay, so as you said, that's been a disappointment. You say you've got a mix of institutional and retail investors. Do you think that a number of those came in on the kind of crest of the ESG wave and have lost interest in green matters? Is that a real thing? We hear it written about in the media, but have you experienced any evidence of that, of people going cool on green issues?
Well, there's a good example of that in the UK. The UK government has clearly got slightly cool on the green issues. And one of the key things that has affected the portfolio in the UK is the government had originally said phasing out the internal combustion engine on new vehicle sales by 2030. And of course, now they've said 2035, maybe. So that has had a direct impact on hydrogen and mobility and transportation sector in the UK, for sure. And I've no doubt that some retail investors have picked up on that. And so if you're working on a short-term investment horizon, I can understand why you might want to redeploy your capital. But for our institutional investors, that's a very short time frame, and they understand that the hydrogen sector globally and in the UK could jump at any moment, mainly fueled by companies and M&A. So they're happy to stay in. So yes, it could have been a part of the decision-making behind retail investors. I don't know. But at the same time, I also understand that the cost of living has increased immensely over the last 2 or 3 years since we've been running the fund. And I can understand why retail investors may want to redeploy their capital. So yes, it could have been part of the decision making. I don't know if it was a big part, but it's been a factor. But the UK government, whatever they say and do, doesn't bother us too much, because this is a global fund and we can redeploy our capital into European markets where there are billions sitting in grants, and in the Inflation Reduction Act in the US, billions of dollars out there waiting to go into the hydrogen sector.
But what you'd really like to see would be some M&A going on to prove what you've just said, your thesis that this is a growth business and there will be, in due course, companies that are setting out on a venture capital basis will eventually be absorbed by larger companies. Or you want to see a change in sentiment towards the market, or the UK market in particular, whereby you can see the discount disappear. I mean, it's quite a long way to go. But it has been interesting looking at your share price. I mean, it's been very volatile in the last few weeks. I have actually been following that. I track it every week, what happens to all the share prices. And it's been on a bit of a roller coaster ride, your share price. It's sort of up and down by significant amounts. And every time it looks like it's about to break out in the right direction, it kind of sinks back again.
Yes, short-term trading and profit-taking. I mean, this happens. This is just a fact of life of being a listed stock. But JJ Trainer, my other co-founder and partner in this business, we spent most of our careers prior to this working in the oil and gas sector. And so we know what volatility is all about. We also understand quite a bit about the energy complex and about people saying, isn't hydrogen expensive? Not compared to oil and gas. And the amount of capex, the capital expenditures that we were making in oil and gas businesses, drilling $100 million wells at a time that they may or may not find oil. The joy about being in the hydrogen sector is it's water. So you've got energy security, you need access to water and green electricity. So fundamentally, it's a very attractive sector compared to oil and gas. But the short-term volatility, I think, is just around short-term trading. You've got to take a longer-term view here and understand and get confident around the industrial principles of this, and they are solid and strong. And that's why strategic investors are co-investors with us into our portfolio companies. Jeff Bezos at Amazon, Centrica, Hyundai, Baker Hughes. Investors should get confidence that these people really understand what's going on in the industrial world of hydrogen, and they are the ones that are co-invested into these companies with us. And so that is strong, but we can't stop short-term trading and volatility. But you've got to take a position and a view on hydrogen, and if you do, you have to own HydrogenOne.
Would you ever consider listing somewhere else because you might get a better rating than the poor old UK market, which has been, as everybody's been pointing out for quite a while, pretty unloved, and valuations of similar looking stocks are very different in different markets. So you chose to list in the UK. Do you perhaps regret that a little?
No, I mean, JJ and myself, we've been in UK markets for decades in other positions in broking and in banking. We understand the way the market works. We understand investors. We can't wriggle out of this by being smart and trying to trade somewhere else. The way to demonstrate this thing is working is through the exits from the portfolios, as you said. That's good and solid, and you can't argue with that. And it doesn't matter where we're listed. That's the sort of thing that's going to change the perception of investing into hydrogen.
Right. So I'm just looking at the numbers now. I look at how the shares have performed year to date and, in fact, the last week as well. And the numbers pretty similar. And also since the interest rate expectations changed in the end of October. And you're basically, the shares are up around 16%, I think, on all those three measures. But it has been very volatile. Do you see any signs that there's any change in sentiment? Are you getting potential new investors knocking on your door at this particular point? Or are they all concerned about liquidity and the volatility and so on? Is that a inhibiting factor, do you think?
It's an interesting point you raise, actually. Yes, we have had more inquiries from the sort of high net worth and larger IFA market in recent months. And they're people seeking value in the market. And they're wanting to talk to us directly just to understand, is this for real? Do these guys know what they're doing? And so JJ and I and the rest of the team have been discussing and interviewing with more people who've clearly picked up on the discount and want to see what's behind it. So yes, there has been more of that recently.
Right. So the message you're basically giving everyone is that it's been a very sticky start as it's turned out, mainly external events. Would you say your portfolio is performing as you expected, apart from the fact that the UK government net zero policy has changed? So you would say to your investors, NAV is still north of where we launched and we're doing our part of the job. It's just the market that is not yet primed to capitalize on what we're doing. I'm trying to put some positive words into your mouth here.
Yeah, thank you. No, it is that. But we have got to demonstrate and prove that this is happening through exits through these businesses. So that's our responsibility. And that's where our focus is. And the way we see it, we're highly confident that this hydrogen market is just going to carry on growing. And like all markets, the volatility works both ways. You could get left behind if you're not part of this story when things suddenly happen and momentum really starts to build in a positive way. But we're engineers and scientists in HydrogenOne. We seek logic and solid growth potential when we invest into these businesses, and that's what we seek.
Well, clearly there's a lot going on there, and I wish you well with that. So thank you very much. That was Richard Hulf, the managing partner and co-founder of HydrogenOne Capital, which looks after this listed investment trust, HydrogenOne. So earlier this week, I had the chance to talk to Joe Rowland, who is a fund analyst at Investec Rathbones, or Rathbones incorporating Investec, depending how you want to describe it, following the merger between these two significant players in the wealth management business. So it seems a good opportunity, Joe, to talk about this because the merger has taken place. You're a much bigger firm than you were before. But tell us how the clients are dealt with within this new combined firm. Obviously, all the Investec clients are still carrying on with the same managers and advisors and so on. Is that how it works?
Yeah. Hi, Jonathan. Thanks for having me on. Yes, very much so. Each client is sticking with the same advisor as far as I'm aware. And then over time, we'll be integrating the investment processes and so on and so on. But yeah, hopefully aiming for a seamless transition.
So for the moment, though, you're still running all your portfolios the same way and Rathbones are still doing the same with their clients. But at some point, that process will be consolidated, as you said.
Exactly, yes.
It's quite helpful for listeners to understand how these things work. Now, obviously, traditionally, wealth managers like Investec and like Rathbones have been significant investors in investment trusts. So tell us what role investment trusts play in the firm's processes and client base.
Investment trusts are extremely important to Investec and client portfolios. In my opinion, they are by far the best way for retail investors to access certain asset classes, such as private equity, small caps, and some hedge funds for numerous different reasons. So because of that, they will remain a staple for our portfolios going forward. But in some areas, we will be looking at using less of them. For example, where you've got a liquid underlying portfolio, but wrapping it up in an illiquid wrapper doesn't necessarily make sense for our clients. But for those niche areas which are liquid, which you can't access in another way, it makes a lot of sense. It still offers clients daily liquidity in a wrapper that has proven to work through many cycles. And it makes a lot of sense in terms of manager access, overcommitments, lack of cash drag, no illiquidity mismatches, no forced selling, all these sorts of things. So they're really important to us. We like the asset class for many different reasons, and I think we'll be using them going forward for a long time.
So unlike some other firms, you won't be moving to a process whereby you have essentially kind of model portfolios made up of ETFs or passive vehicles and so on, and you approach investing that way. I guess you do have some clients who are on that kind of basis, but what you're telling me is that for the foreseeable future anyway, investment trusts will remain part of the product mix that your firm is going to use.
Yes, seemingly so. We will have clients who have ETF or passive portfolios, and most clients will be a mixture of different structures and products. We offer a bespoke service for those reasons to make sure we can deliver whatever the client requires. But from a central research perspective, we will be providing IMs with the right structures to invest in for their clients.
So you did mention there, though, in passing, that you might be investing a little bit less in some types of investment trust. Is that for regulatory reasons, or is it just because of a combination of that and your own liquidity concerns, as it may be?
I wouldn't want to speculate exactly on how it's going to work out. But for some areas, it makes less sense. For example, if you've got a large cap US fund, the underlying portfolio is extremely liquid. So wrapping that up in a less liquid wrapper, that's say a £200-300 million market cap, makes less sense for us. So I think we're going to be maybe potentially more selective on the types of investment trusts we look at. But for certain asset classes, it's still very attractive.
Okay, so we've obviously read a lot about the issues of cost disclosure as far as they affect certain types of investment trusts, particularly alternatives of various sorts. That obviously is a concern for you because the bigger the firm gets, the more of a vehicle you may have to buy in order to meet your clients' needs. So that is limiting the number of trusts that you can realistically invest in as far as you see it. Am I right about that?
The cost disclosure issue is a challenge. It's definitely not helpful when speaking to clients because obviously it looks expensive ostensibly. However, we hope to look at these things on a net of fee basis. If something's outperformed really strongly for decades, but does charge high fees, that net of fee performance is what we ultimately care about from a central research perspective. So we're not going to deny anyone access to that simply because it seems high. I'd hope that IMs can explain comfortably to the clients why they appear high, and hopefully I can help them explain why it's worth those high fees. But obviously we want the cost disclosure issue to be resolved, and the costs need to be comparable across different structures and easier to understand for the end client.
But is it at the moment inhibiting you from making recommendations that you would otherwise make?
I wouldn't say it's inhibiting recommendations I'd otherwise make. We are obviously very fee conscious, But if, as part of a strategy, they need to use an RCF or they need high trading costs or something like that, if it makes sense, we're not going to be penal for the sake of it. We'll take a pragmatic approach to it and try and be as sensible as possible and as rational as possible and not get sworn off by the fees. PE is a good example here. Obviously, they look very expensive. The RCF, the interest costs make them look more expensive as well. It's a challenge, but hopefully we can get people on board and explain this clearly and see why they're worth those costs.
I suppose one interesting question around that is whether you, directly or indirectly through your investment managers, the IMs, are hearing pushback from clients. Are you actually getting pushback from clients saying this looks very expensive, or is that something which the FCA is concerned about, but actually it's more apparent than real when it comes to conversations with clients of yours?
I think, obviously the IMs are close to this. They'll be feeling the impact of clients demanding or wanting cheaper options. But in general, I think, IMs are going to be capable to explain to clients why the fees are worth it in certain cases, why this asset class or this particular product is worth the fees. We're not being light on the issue. We are very fee conscious, but we need to make sure we're being pragmatic.
And so when it comes to making recommendations, your job is to analyze specific trusts in this context and make recommendations to the investment managers, the IMs. How big in practice is your universe? There are between 300 and 400 investment trusts, if you go all the way down the scale, excluding VCTs, venture capital trusts. So how big is your universe in practice, would you say, out of those 300, 400 names?
It's a good question. I wouldn't want to put a specific number around that because we wouldn't want to close ourselves off from some really good opportunities. There's potential for some hurdles to be put in place of what kind of size that we're going to be looking at. But as always, we're going to go to where we think the best opportunities are. We can't go for the tiniest trusts for obvious reasons. But if something is really niche, really worthwhile, we will still look at it and make a case for it. We need to balance the investment proposition to kind of how much money we can allocate to it. Obviously, we don't want to end up owning loads of every trust. But sometimes it's worth owning quite a bit of a trust because the underlying isn't accessible to retail clients in any other form. So we have to be pragmatic along those lines.
So if I sort of put that in real life example terms, you read in some places that a trust has a minimum market cap around 500 million now. Some people say for you to invest in it. But are you saying that doesn't really apply to you and that you might look at something like a microcap trust, which has got a market cap of 80, 100 million? Would you ever look at something like that?
I think we look at it. As we integrate our process with Rathbones, we may be looking at some sort of guidelines as to what is practical for the business. But I wouldn't like to put a specific figure on it. Realistically, obviously, we want larger trusts. It's not a secret. It seems fairly intuitive. I think it's not just us in the industry. There's lots of other big players as well who want larger trusts. If we find an idea that's worth spending the time and analysing and you really like it, we obviously want to put a decent amount of capital behind it. So if you had an idea that you did want to own more than 10 or 20%, £80 million market cap, that puts you at £8 to £60 million. Probably not enough unless it is massively compelling. But to go on our centralised buy list, probably needs to be a bit larger than that. But at this point, we look at everything and try to not let size be a real factor here. But there's no denying that we do want trust to be larger.
You mentioned there you've got a centralised buy list. Roughly how many names are on that centralised buy list at the moment, and how regularly would that change?
So we have around 200 names, that's including funds and trust, on the buy list at the moment. The turnover varies. It's very market dependent. We're always looking at new names and we're always looking at see areas we can upgrade and downgrade products where we think we have better ideas. Difficult to put a figure on it, but I'd say we probably make maybe 5 to 10 additions a year and a similar amount probably come off. But yeah, it's market dependent.
Can you give me some examples of things that have come on or come off?
In the open-ended world, we've added a few funds recently. We've added Insights, short duration high yield fund and floating rate fund. We haven't added a trust for a little while, but it's definitely something we are looking at. And on what we've got rid of, again, nothing particularly springs to mind on that front.
What sort of split on your universe is there between, broadly speaking, alternatives and more conventional equity trusts, would you say, roughly? I mean, it's about 50-50 in terms of the split between the two at the moment across the whole universe, but is there a particular bias towards alternatives or equity trusts in your case?
It depends how you define alternatives. If you include infrastructure and property, you probably have slightly more in that asset class compared to equities. But overall, we have around 80 trusts on the list across all asset classes. So we've got a few in hedge funds, quite a lot in equities, quite a lot in property and infrastructure.
Okay, so obviously we all know that the last 2.25 years have been really tough ones for the investment trust sector. We've seen discounts balloon out quite wide, up to average 18%, starting to come in again. Do you, as a house, have a view about where those discounts are heading, or is it more a case that you are looking at specific trusts and whether you see the potential for re-rating? How big a factor is that in your analysis?
This is super important to us. I'd say we wouldn't have a specific target on where we expect discounts to get to. It's very much asset class dependent and board dependent. So this is where we spend a lot of time with boards. We meet boards of on-list trusts at least once a year to discuss discount management policies, when they buy back, how much they're going to buy back, what's the process for this, is the best use of shareholder capital. So we kind of think around things of, do we think this is the best use of capital? Also, another important thing is if the buybacks are going to shrink the trust to a really small extent, which then lowers liquidity, which is also an issue. We are looking for trusts to undertake innovative methods to try and close a discount and keep discounts narrow, such as performance-based tender offers or just normal tender offers. And in certain cases, large buybacks. We probably prefer a commitment on an ongoing basis rather than saying we're going to do £300 million of buybacks in the next 2 years, because once the 2 years runs out or the 3 years runs out, then what happens? So if a trust or a board makes a commitment to say we want to keep the discount between 0 and 5%, and if it gaps out to 10, you can count on us to be there. That gives us a lot of confidence. We know that we can rely on the boards to act in our interests, and we know that if the discount does gap out to say 10%, we know that's a good opportunity to buy in because we know the boards have our backs and they're coming in to support the share price at that point. And that's what we're really looking for, because we're looking to invest in these trusts on an ongoing basis and hold them for a long time.
Right. So when you're analysing them, basically you are analysing the outlook for NAV, shall we say, and then the question of the discount and whether or not the board is going to support through buybacks or tenders or whatever. That's a kind of secondary factor, is it? Or are you actually looking for things that are cheap and therefore you want to get in while the discounts are wide? How do you weigh up those different factors?
So we will look at the manager quality first. So we will decide if this is a good manager running the underlying portfolio, if how they invest makes a lot of sense to us. Do we think it's going to add alpha? Is this a good risk-adjusted way to invest? All the sort of usual manager selection points. And then on top of that, then we'll look at the corporate governance. Is this trust governed well? Do we have faith in the board? Are they going to act in our interests? Are they going to control the discount? Are they going to keep it the right size? Are they spending the right budget on marketing? All these sorts of things. We're probably too big to be going in and out of trusts all the time. And you don't have to be that big for that to come true. So yes, of the trusts that are on our list, we do look at discounts and highlight the things that we think are cheap or expensive, but we're not going to buy a trust just because it is looking cheap on a tactical basis.
And if we look across the universe, I mean, are there particular sectors at the moment which you're spending a lot more time looking at because you think there is potential there? I mean, you mentioned small cap, for example, and you mentioned Japan, and you mentioned private equity trusts as being particular sectors that you look at, personally anyway. Do you have a positive view on all of those at the moment?
Broadly, yes. So UK small caps, I think this is looking attractive at the moment, and the discounts also are quite attractive as well. So in general, the portfolios are looking cheap relative to large caps, cheap to global peers, global small caps, cheap relative versus history. So that's all looking favourable. Add on a discount, it looks even cheaper. So yes, that looks attractive to us, and we hope that discount will be realised soon. We know that there's still potential for outflows in UK small caps, but we're hoping that the companies themselves can start to be their own catalyst through buybacks. And we're hoping that eventually, at some point, the market realises that UK small caps look too cheap. And we don't want that to happen after the PE guys have taken the vast majority of the good companies. So we hope that happens sooner rather than later. Similarly, we think private equity looks quite cheap as well. A lot of these trusts are on large discounts, despite having proven that over the last few years, they can still sell their companies at premiums to the NAV, or the carrying value. For example, HGT, despite being in tech and having exposure to debt, we felt that as a lot of the debt is termed out and a lot of the interest rate exposure is hedged, the market over-exaggerated the impact of higher rates. and the decline in valuations. And they've shown that by selling around 10 companies at circa 30% premiums to the carrying values. So I think that's an opportunity. And that's not just true for HGT. We think that's true for Pantheon and Harbourfest as well. One of the key things I think is inefficiently priced is the venture capital segment of HVPE. This is an area where many people see the fact that the recently IPO'd companies, or the companies that IPO'd in 2021, sold off circa 70%. And they assumed that the venture capital owned companies in the portfolio were going to sell 70% as well. But actually, during 2021, these companies are sold at around 120% premiums to the carrying value. So they really don't have as far to fall. And that's something that we think is mispriced and attractive to us.
So you're not worried about the fact that Harbourfest is one of these trusts that has been particularly affected by the cost disclosure issue and the high fees and so on that people talk about a lot of these particular types of private equity trusts?
It is undoubtedly expensive. Is it too expensive? Potentially. But if you look at the net of fee performance over the last 10, 15 years, I think you'd have been pretty happy with that despite paying away quite a lot of performance.
And in the Japanese sector, a lot going on in the Japanese sector at the moment, been obviously a very good performer over the last year. Do you have some favourites there? Did you support the deals that Nippon Active Value have been doing, for example? Were you involved in that at all? Did you invest in any of the other trusts that led to that combination?
We didn't invest in that one, but I am supportive of those sort of deals. It definitely makes sense to merge similar sort of assets and make them larger trusts for us. And that, again, opens them up to bigger investors, which seems very sensible. I wouldn't like to say a specific trust, but I think small caps could be quite attractive from here. Similarly, a lot of the growthy small caps have sold off to a level where they're trading at similar valuations to the index, despite having achieved far higher growth, being less cyclical. So that is attractive to us. And again, if you got that on a discount to NAV, that seemingly looks quite attractive. Unfortunately, it is a bit of a currency play. The small caps seem to have been disproportionately affected by the weak yen, which is understandable. But there's potential for mean reversion within that. So that's something that investors should be aware of. And I think that's something that's been underappreciated by the market as well. The divergence between large caps and small caps has been impacted by currency. The large caps benefiting strongly from the strong dollar and the small caps lagging behind. If this reverses, and we think if US rates start to drop at some point, growthy US small caps, growthy Japanese small caps could look quite attractive.
So you're talking about something like Bailey Gifford, Shin Nippon, or something like that. I won't ask you to name names if you don't wish to, but something like that?
Potentially, yes. I think that's an attractive name at the moment. Similar valuations to the index, much higher growth. I guess investors should be aware that it is about 18% leverage. So if things go well, it's going to look really well. If things go badly, it could look a bit worse. But on a long-term view from here, if you're buying better quality companies with better growth at the same valuation as the index, I think you're going to do okay.
Can I ask you also about Scottish Mortgage? We're talking about Bailey Gifford, one of the largest trusts in the sector. Also had a very exciting, turbulent couple of years, I think it's fair to say. I'm guessing that a lot of your clients have been invested in that for a long time and continue to invest in it through the ups and the downs. But do you have a particular view about where the shares and the company are at this particular moment, having refreshed the board and announced these shocking buyback programs, including one yesterday, which is very substantial, possibly the largest ever done, I think?
Yes, we do invest in Scottish Mortgage, and you've got a lot of clients invested in that, and it's made a lot of money for them over the long term. The buyback is large in absolute terms, but it's around 7% of the trust overall. That doesn't seem huge to me. I think that's not the largest in the sector that we've seen, but it's definitely a good start. However, they committed to $1 billion over 2 years. What happens after the 2 years? Does the market then realise that, oh, there's no more buybacks coming our way, and then it gaps out again? Or would it be better to know that they're going to be there on an ongoing basis and say, we're going to start with definitely going to put $1 billion into the market, but we're going to invest in our own shares on an ongoing basis as well to try and keep the discount tight.
On some sort of criteria? I mean, do you actually favour discounts that are based on a hard criterion to give you that confidence?
In certain cases, yes. We don't want them throwing money just to keep it always narrow, because sometimes it's just too much selling pressure and it's potentially a waste of capital. But most of the time, a hard threshold is preferred. We know the boards have our backs at that point. It helps keep it narrow. So if they say the 10 is the point they'll start stepping in, if it goes to 10, we know they'll be there soon, and we know that it's not a time to sell. as probably a time to buy. So that gives us a lot more faith on an ongoing basis.
Finally, if I can talk about any other sectors you think would be particularly interesting for listeners to look at the moment, not necessarily saying you're recommending them, but just looking at, what other sectors would you say, or is the firm looking at, do you think, in a positive light at the moment, given your views about where we may be in the cycle?
So BH Macro is something that looks quite attractive to me. Depending on where you think you are in the cycle, this underlying capability has traditionally added value during the tough times with its long volatility profile. We hope that will be the case going forward. And whilst it obviously is an issue with the merger and the ownership, I would not speculate on how that's going to be resolved. But do we think that's going to be an issue in 10 years' time? I'd really hope not. I think the average investor would hope not as well. I think the market will frankly get over it. So if you like the underlying returns that have been uncorrelated for around 20 years and provided a very good return, uncorrelated to bonds and equities, so it's done well when you really needed it to, now you can buy that at a double-digit discount, and that seems quite attractive.
Yes, and of course, what you're referring to there is the fact that both Investec and Rathbones do own a significant chunk of BH Macro, and so some people might think it's a bit of an overhang over the share price. But what you're telling me is that as far as you're concerned, it's still a potentially good investment for a long-term investor.
Definitely. And I think it's quite unique as well. I don't know of many other trusts where you have that profile of consistently adding value when you really need it. And you never know when you're going to need that. So that's really attractive for investors. There obviously is the issue of Investec Rathbones ownership, but I still think it's very attractive at this time.
Okay, so that was Joe Rowland, who is a fund analyst at Rathbones Investec, or call them what you prefer to call them, talking to us about their process and how they see the market at the moment.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.